समझ नहीं आ रहा अपने सैलरी इंक्रीमेंट का क्या करूं।
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स के एसआईपी का टॉपअप करा ले. दिस इज द राइट टाइम.
क्या? समझ में नहीं आया.
बेटा इतना क्या सोच रहा है? अपने म्यूचुअल फंड्स का एसआईपी टॉपअप करा ले. दिस इज द राइट टाइम.
आप समझा.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Hello and welcome to The Print. This is Bidisha and you're watching Economics. Let me start with what everyone is witnessing right now. Oil prices are rising sharply again. Geopolitical tensions, especially in West Asia, are clearly playing a role. Global growth is not exactly booming. So the natural assumption is simple. Oil prices are rising, inflation will rise, and as a result, interest rates will be high. Sounds logical, but here's the problem. That explanation is incomplete. Because even before this latest spike in oil prices, even before tensions escalated the way they have now, interest rates across the world were already stubbornly high. So what we are seeing today is not just a reaction to current events. It is part of a deeper shift in how the global economy works and how markets think. And that is exactly what this explainer is all about. Now, before we go further, let me answer a very important question. Why are we even discussing this? Why does this matter? Because interest rates are not just a number. They affect your home loan, your business investment, government borrowing, job creation, economic growth itself. If interest rates remain high for longer, the cost of money stays high. Now, what does that mean? That means loans will become expensive, investment slows down, and growth becomes more fragile. And for countries like India, global interest rates shape capital flows, currency stability, and financial conditions. So this is not just a financial market story. This is a story about the cost of uncertainty in the global economy. Now let me simplify what's really going on. What we are witnessing today is not just high interest rates. We are witnessing a change in the rules of the game. And that change began around 2023. Not 2026, but 2023. So if you take away one thing from this video, it should be that markets had already decided that the world is structurally more uncertain. What we are seeing now is just reinforcing that belief. For a long time, global shocks were seen as temporary. Oil prices spiked, they will come down. Supply chains have broken, they will heal. Inflation has risen, it will settle. This idea was called transitory inflation. Now, what does transitory inflation mean? It simply means temporary inflation. Prices go up for a short period because of a shock and then are expected to come back down on their own. In other words, it's not seen as a lasting change in inflation, but something changed. Markets began to realize that shocks were no longer temporary. They were becoming persistent. Think about the last few years. The Russia-Ukraine war, fragmentation of global trade, supply chains being reorganized for security, and climate-linked disruptions even. This is not about one shock. This is a pattern of recurring shocks. So the inflation stopped being temporary. It became a recurring risk. Now, if you look at the first chart on your screen, it captures this shift. Earlier, there was a predictable relationship. When oil prices go up, inflation goes up and interest rates rise. And when oil prices go down, inflation decreases and interest rates go down. But after 2023, that relationship clearly weakens. Even before the current spike, there have been phases when the oil prices stabilized, even softened, but the interest rate stayed high. That is the structural break. And what that tells us is very important. Interest rates are no longer driven only by current inflation. They are driven by uncertainty about future inflation. Let me explain one key idea here: term premium. When investors lend money for 10 years, they ask, what could go wrong over those 10 years? Inflation could come back, policy could change, geopolitical shocks could disrupt the system, so they demand extra return. That extra return is called the term premium. For most of the 2010s, this was low because the world felt stable. But after 2023, uncertainty rose, so the term premium rose as well. And that pushed long-term interest rates higher, even without strong growth. There's another layer to this. Earlier, inflation was expected to come down quickly. Now it is seen as something that can return again and again and again. Why? Because energy markets are strategic, supply chains are being redrawn, costs may not go back to earlier levels, so inflation expectations are becoming less stable. And when expectations shift, long-term interest rates rise because they reflect the future. The second chart that you see on your screen shows how quickly markets have adjusted. Between February and March 2026, expectations move sharply towards, let's call it, higher for longer. Markets are no longer confidently expecting rate cuts. In fact, they are even pricing the possibility of further tightening. And here's the key insight. This is happening without strong growth. So high interest rates are not a sign of strength. They are a sign of persistent risk. Now coming back to where we started. Yes, oil prices are rising right now. Yes, geopolitical tensions matter. But they are not the root cause. They are reinforcing something markets already believed. They believed that disruptions will continue, that inflation risks will reoccur, stability cannot be assumed. So this story did not begin in 2026, it began in 2023. Now we come to the more important question: why is this happening and what is missing exactly? In earlier periods of rising geopolitical risk, governments responded strongly. They used fiscal policy. Large-scale public spending, energy security investments, industrial expansion, monetary policy worked alongside this. But today, fiscal responses are fragmented. They are limited. And yet, the risks look very similar to a wartime-like environment. So what happens? Central banks are forced to do more. Interest rates are kept high not just to fight inflation today, but to prevent inflation from coming back tomorrow. This is essentially what I would call wartime-like financial conditions without wartime-level fiscal coordination. Now the question is, so what should be done? Now this is critical, because if the problem is structural, the solution also has to be structural. Policy cannot just focus on managing inflation or supporting growth. It has to address the sources of uncertainty. That means investing in energy security, building resilient supply chains, strengthening domestic production capacity, creating that fiscal space to absorb shocks. In other words, policy must move from managing cycles to managing risks. This is the shift from a business cycle world to a risk cycle world. And unless policy catches up with this reality, monetary policy will continue to carry too much of this burden, and interest rates will remain high. For India, this has very real implications. Even if domestic growth is stable, global financial conditions are likely to remain tight, which means cost of capital stays high, capital flows become more sensitive to global risk, external shocks transmit more quickly. So policy in India cannot be inward looking alone. It has to factor in a world where uncertainty itself has become structural. There is a temptation to look at high interest rates and say, this shows resilience. But that would be a mistake. High interest rates today are not a sign of strength. They are a signal of caution. Markets are essentially saying, we are not convinced the shocks are over. And until policy responds in a credible, coordinated way, interest rates will remain elevated, persistent, and quietly signaling that the global economy is still bracing for what comes next. Thank you for watching.